Crypto arbitrage sounds like free money. Bitcoin is $80,000 on Coinbase, $79,500 on Kraken. You buy on Kraken, sell on Coinbase, pocket $500, rinse and repeat. No market risk, pure profit from price differences. Influencers show screenshots of easy $1,000 daily gains. It looks like a money printer. Here's the reality. By the time you execute the trades, the spread is gone. Fees eat your profits. Withdrawal delays lock your capital. Tax complications destroy your returns. And for 99% of people, the math doesn't work. This video breaks down what arbitrage actually is, the real costs nobody mentions, why most people lose money trying it, and whether it's possible in 2026 or just another trap. Arbitrage is exploiting price differences across exchanges. Bitcoin trades at different prices on different platforms simultaneously. Binance, $80,000. Gemini, $80,200. Kraken, $79,900. You buy where it's cheap, sell where it's expensive, and pocket the difference. In theory, it's risk-free profit. You're not betting on price direction, you're capturing inefficiencies. That's the concept. In practice, it's far more complicated. YouTube and Twitter are full of arbitrage gurus. They post screenshots showing $500 to $2,000 price differences between exchanges. They claim to make $1,000 plus daily with minimal effort. They sell courses teaching secret arbitrage strategies. The pitch: you need $10,000 starting capital. You can double your money monthly. All you do is move coins between exchanges. It's passive, it's low risk, it's beginner friendly. Everything they say is either misleading or false. Every trade costs money. Buying fees 0.1% to 0.5% depending on exchange and volume. Selling fees another 0.1% to 0.5%. Withdrawal fees, blockchain fees to move coins between exchanges. Bitcoin $2 to $20 plus depending on network congestion. Ethereum $5 to $50. Deposit fees, some exchanges charge to deposit. Total round-trip cost 0.5% to 2% easily. Example: Bitcoin is $80,000 on exchange A, $80,400 on exchange B. That's a $400 spread, 0.5%. After 1% in total fees, you're at break-even or slightly negative. The spread needs to be 2% plus to profit. Those opportunities are rare and disappear instantly. Price differences last seconds, sometimes milliseconds. By the time you see the opportunity, bots have already taken it. The process: you check prices manually, you see a spread, you log into exchange A, you buy Bitcoin, you initiate withdrawal, it takes 10 to 60 minutes for confirmations, you deposit to exchange B, you sell. During those 10 to 60 minutes, the price moved, the spread closed, you're now selling at a loss. Reality profitable arbitrage requires automation, bots that execute in milliseconds, APIs connected to multiple exchanges, algorithms that calculate fees in real time. Most retail traders don't have this. They're competing against professional trading firms with sub-millisecond execution. You can't win. Moving Bitcoin between exchanges isn't instant. Bitcoin, 3 to 6 confirmations required equal to 30 to 60 minutes. Ethereum, faster but still 5 to 15 minutes. Altcoins varies wildly. During this time, prices change. Real scenario: you see Bitcoin at $80,000 on Binance, $80,600 on Coinbase. You buy on Binance, you withdraw, it takes 45 minutes. By the time your Bitcoin arrives at Coinbase, the price dropped to $79,800. You're down $200 plus fees. The arbitrage opportunity cost you money. This happens constantly. To arbitrage effectively, you need capital on multiple exchanges simultaneously. Example: you have $10,000. You can't keep it all on one exchange. You need $5,000 on exchange A and $5,000 on exchange B. This way you can buy and sell instantly without waiting for transfers. But now your capital is fragmented. Half sits idle waiting for opportunities. Your effective capital is halved. Plus, keeping money on multiple exchanges increases your risk exposure. If one exchange gets hacked or collapses, you lose everything there. Remember FTX, Celsius, Voyager, BlockFi, all collapsed. Users lost billions. If you're arbitraging, you're holding funds on multiple exchanges. Risk multiplier, instead of trusting one exchange, you're trusting 3 or 4. Your risk increases proportionally. One goes down, you lose a chunk of capital. Real example, you have $3,000 on FTX for arbitrage. FTX collapses. Your $3,000 is gone. Your risk-free arbitrage strategy just lost 30% of your capital. No amount of arbitrage profits recovers from that. The exchange risk alone makes arbitrage not worth it for retail traders. Every trade is a taxable event. You're making dozens or hundreds of trades per month if you're actively arbitraging. Tax reality: buy Bitcoin for $80,000. Sell for $80,400. That's a $400 taxable gain. Multiply by 100 trades per month. You owe taxes on $40,000 in gains even though your net profit after fees might be $5,000. Record-keeping hell. You need to track every single trade. Entry price, exit price, fees, timestamps, exchange. If you're arbitraging across multiple coins and exchanges, you have thousands of transactions annually. The accounting cost, software or CPA, eats into profits. Most people underestimate this until tax season destroys them. Slippage is the difference between expected price and executed price. You see Bitcoin at $80,000. You try to buy $10,000 worth. The order book is thin. Your buy order pushes the price to $80,050. You paid $50 more than expected. Same happens when selling. Large orders equal to large slippage. Small orders avoid slippage but make arbitrage unprofitable because fees are a bigger percentage. Real math: you need to move $10,000 plus to make meaningful profit, but moving $10,000 on a thin order book causes slippage. Your $500 spread becomes $200 after slippage and fees. Not worth the risk and effort. Arbitrage between countries is even riskier. Bitcoin might trade higher in South Korea or Turkey due to capital controls. Seems like an opportunity. Reality: moving money internationally triggers AML and KYC regulations. Banks block transfers. Exchanges freeze accounts. Governments investigate. Example: you try to arbitrage between us and Korean exchanges. Your Korean exchange account gets frozen for suspicious activity. Your money is stuck. You can't complete the arbitrage. You can't withdraw. The opportunity is gone and your capital is locked. Cross-border arbitrage is a legal and logistical nightmare. Let's say you successfully arbitrage $10,000 and make $200 profit after all fees and costs. That's 2% return. Sounds okay, but you spent 10 hours researching, setting up accounts, executing trades, and managing transfers. Hourly rate, $200, 10 hours equal to $20 per hour. You could work a regular job for $20 per hour with zero risk. Or you could have just bought Bitcoin and held it. If Bitcoin appreciates 50% over the year, your $10,000 becomes $15,000. That's $5,000 profit versus your $200 from arbitrage. Opportunity cost is massive. Arbitrage feels productive, but it's a low-return, high-effort grind that underperforms simple buy and hold. There's one scenario where arbitrage is profitable. You're an institutional trading firm with sub-second execution via API bots, accounts pre-funded on 10+ exchanges, proprietary algorithms calculating fees and slippage, direct relationships with exchanges for lower fees, legal and compliance teams handling regulations. If that's you, arbitrage works. If you're a retail trader with $10,000 trying to manually arbitrage between Coinbase and Kraken, you're going to lose money. The infrastructure gap is too large. You're bringing a knife to a gunfight. You have $10,000. You set up accounts on Binance, Coinbase, and Kraken. You spot a $300 spread on Bitcoin. You buy on Binance for $80,000. Fees, $80, 0.1%. You withdraw Bitcoin. Withdrawal fee, $15. It takes 45 minutes to arrive at Coinbase. The spread closed. Bitcoin is now $79,900 on both exchanges. You sell at $79,900. Selling fee, $80. Total fees, $175. Your result, bought at $80,080, including fees. Sold at $79,820. After fees. Loss $260. You tried to capture a $300 spread and lost $260 instead. This is the typical retail arbitrage experience. Professional arbitrage bots execute in milliseconds. They see price discrepancies before they appear on your screen. They execute, capture the spread, and close before you finish typing your order. You're competing against high-frequency trading firms, market makers with exchange rebates, bots running on co-located servers next to exchange data centers. You have a laptop, a browser, manual execution. The competition is unfair. The bots win 99.9% of opportunities. You get the scraps that aren't profitable. Sometimes you see huge spreads. Bitcoin is $80,000 on Coinbase, $85,000 on some random exchange. That's a $5,000 spread. Why it exists? The random exchange has no liquidity. Nobody is actually buying at $85,000. It's a fake price. If you try to sell there, your order wouldn't fill, or the exchange is a scam. They show high prices to attract deposits. You deposit, they steal your funds. Rule: if a spread looks too good to be true, it's either illiquid or a scam. Legitimate spreads on major exchanges are 0.1% to 0.5%. Anything above 1% is suspicious. Take the $10,000 you were going to use for arbitrage. Buy Bitcoin. Hold it in self-custody. Don't trade. Don't arbitrage. Don't try to outsmart the market. Just hold. Over 5 to 10 years, Bitcoin's appreciation will dwarf any arbitrage profits. You avoid fees. You avoid exchange risk. You avoid tax complications. You avoid competing with bots. You avoid the stress of monitoring prices 24/7. It's boring. It works. Arbitrage is exciting. It loses money. If you somehow manage to make 2% per month arbitraging, you won't. That's 24% annually. Sounds great until you compare it to Bitcoin's historical returns. Bitcoin averaged 100% plus annual returns over the last decade. Even in down years, buying and holding beats the stress and risk of arbitrage. The effort to reward ratio is terrible. You're working hard for small gains while taking massive risks. Buy and hold requires zero effort and produces better returns. Retail crypto arbitrage is dead. It worked in 2013 to 2017 when markets were inefficient. Bots killed it. By 2026, every profitable opportunity is captured by algorithms in milliseconds. If you see a spread, it's either fake, illiquid, or already gone. The arbitrage opportunities retail traders can access aren't worth the fees and risks. The ones that are profitable require institutional infrastructure. You're not competing. You're being farmed. The exchanges and bots win. You lose. Comment "tried it" if you've attempted arbitrage and lost money to fees and delays, or just holding if you're skipping the complexity entirely. Next video, I'm explaining crypto lending platforms, the risks that wiped out billions, and why 8% yields aren't worth it. Subscribe to Unbanked. The old money had a head start. You have the internet,